In this particular section, we're going to discuss about some of the other advanced headers that we see in the balance sheet and P&L statements typically, primarily the balance sheet, because P&L is more or less self-explanatory. When we look at, let's say, the annual report of a company like Eicher Motors, there are a lot of segments that come on this, which would essentially talk about things like deferred tax liabilities, other long-term liabilities, long-term provisions, other current liabilities, so on and so forth, right? Now, what exactly are these headers? How do we know about them? We can go to these note numbers 4, 5, 6, and 9 and try and find out what is exactly listed in these note numbers, and that would give us an idea about what are the details of some of these. So what we're going to do now is try and understand on a definitional perspective what is the idea or definition of some of these headers, and then look at various examples around these headers as we go along and try and understand how those examples kind of fit into our discussions, right? So let's begin with some of these headers as we go along. Uh, some of the new headers that would appear on the balance sheet would talk about deferred tax liabilities. So you could see a deferred tax asset, you could see a deferred tax liability, and you could see a net of any of these. So in this case, we are seeing a deferred tax liability. Now, how does this come in? Typically, there is a Companies Act in India and there's an Income Tax Act in India. So what is the accounting done by the company versus what is the income tax accounting will create a couple of differences. Just to give an example, if the company chooses to take a certain depreciation rate for a certain asset, but the income tax department does not agree to that depreciation rate, they have their predefined depreciation rates. You could have different depreciation rates that are used. And because of this, the tax paid would be different from the tax accounted for. So your accounting tax measure will come from your accounting depreciation measure, which could be different from the actual tax, because the income tax department will say, look, this is what you made and this is the tax that you have to pay. You could account for something else as compared to what is there in the actual income tax segment. And that is where there is a difference between what is being paid, let's say, as a tax and what is being accounted for as a tax. If you have paid lesser than what has been accounted for, this would be a deferred tax liability, right? So you're supposed to pay this at a later date, and that would create a sort of a deferred tax liability at this stage. Slightly a complicated topic for us to discuss in detail as of now, but for all practical purposes, just remember that whenever you see deferred tax liabilities, this is going to be because of different depreciation measures that come up based on accounting and income tax act provisions, right? That's what deferred tax liabilities are. Now, let's move ahead and look at some of the other ones, which are other long-term liabilities. Now, for example, security deposit received for renting out a premise, or long-term advances received from customers. If you received an advance from customer, that's a liability because you are supposed to give out a service or a good in response to this advance that is received, and because you owe that service to the client, that's a liability, right? Similarly, if I have a big factory premise which I have rented out to someone else for their usage, and I have taken a security deposit for that renting out, that will act as other long-term liability, right? There could be other long-term liabilities as well. Next, we move on to something like long-term provisions. Now, some liabilities which have been accounted for in the expense sheet, but they have to be settled in the long run, right? Settled in the long term. Long term is essentially greater than 1 year. An example is employee gratuity. What is gratuity? Once you finish 5 years in your employment in the same company, you get paid out an amount of your salary as gratuity. Now this is already accounted in the employee salary every year. So this is accounted as employee salary every year, but it is paid out only after 5 years. So you keep accounting for it and you keep adding it up because you've not really paid out it, right? So your P&L will show this as employee salary, but your balance sheet will keep showing this as a long-term provision because you have not yet paid it out. You're only going to pay it out if the employee completes 5 years in the company. right? Even if some part of employees compensation is going towards long-term pension kind of instruments, that would also create long-term provisions for the company. An example of this could be extended into short-term provisions as well, right? Liabilities which have been accounted for in the expense sheet would have to be settled in the short term. An example would be dividend. Now companies declare dividend on the end of 31st March because that's where they close the accounts. And so as you close the accounts, you want to kind of declare the dividend at that point of time. If you are giving employee salaries, you could declare the bonus at that point of time. But the actual payment of this could happen at a later date, right? Now, this is a short term. Why is it short term? Because it has to be settled in less than 1 year. Typically, somewhere during the following year, you will have this payment coming up, but you've not paid it right now. So you've declared a dividend, but you've not really paid it, right? That's a short-term provision that would come in. Let's actually go, because we are looking at liabilities first, let's go to the balance sheet of Eicher Motors, the consolidated balance sheet of Eicher Motors, and look at some of these data points there in more detail. So we are going to try and actually go out and look at some of these notes and try and understand what are these data points coming from, right? So let's actually just look at some of these notes. We're going to go to note 5 to look at other long-term liabilities. So just continue following. After your discussion on how do you account things, you look at share capital, you look at deferred tax liabilities, then you have some sort of data coming in other long-term liabilities. Now let's look at other long-term liabilities. You have advances from customers for goods and services. You have security deposits received, right? So those are your long-term liabilities. Long-term provisions, provision for employee benefits, right? So something like gratuity, something like compensated absences, leave encashment, right? Typically, if an employee is entitled 20 days of leave during the year and the employee does not take that, they can encash those leaves because they've worked for those days, right? So those could be encashed. Other employee benefits could come in. What else is there? There are some provisions for warranties and share of long-term provision of joint venture, etc. Some other long-term provisions, not very important for us at this point of time. Provision for warranties would be someone buys the bike from them, and there's a general sense that every year they'll need to spend, let's say, 20-25 crore in terms of some sort of warranty fulfillment on some sort of spare parts. There they would make a provision. They may not have used it right now, they may have expensed it, but they've not paid it, right? So today they have put it as a cost in the P&L because they think this will come, but it may not come at a later point, and hence those provisions would get kind of tackled. Then if you look at short-term borrowings within the notes, you get how much is from bank, how much is from short-term loan, cash credit, etc. And what kind of secured or unsecured loans do they have? They have small data. Then we go to other current liabilities, and you see things like unpaid dividend comes here, things like advance from customers from goods and services, employee dues that you have not paid as of 31st of March or as of December 31st. Gratuity payable, statutory remittances that, things like VAT, service tax, etc., that need to be paid but have not been paid as of now, and other stuff around that could also be there. Short-term provisions could be provisions for dividend, provisions on tax on proposed dividend. Dividend carries a tax, so when you give out a dividend, there is going to be a tax on that. Employee benefits, anything that goes in gratuity in this year. Some employees might be finishing 5 years of their service in this year, so something for that. Other leave in encashments and other employee benefits that could come in the short run. So these are all the short-term provisions that companies make, and that's what we had discussed here in terms of our discussions, right? Now let's go ahead and talk about some of the other headers which are there on the asset side. So if we go back to our asset side of the discussion and we look at the details of the asset side, we see this entire header that comes in which talks about tangible and intangible. That's straightforward. Tangible is any factory, machinery, etc. Intangible is anything that cannot be seen physically. So software, patents, licenses, anything that is there is clubbed under intangible assets, right? Now, we see terms like capital work in progress and intangible assets under development, then non-current investments, long-term loans and advances, other non-current assets, and then short-term loans and advances and other current assets. Rest of them are the kind of self-explanatory. We're going to focus on a few of them. Let's first talk about capital work in progress and intangible assets under development, right? Now, when you look at these, every year, any asset, fixed asset, let's say you're building a factory. You're building a factory that is under construction but not yet completed, right? Now, this would be put in capital work in progress, right? Now, this, once it gets completed, CWIP, capital work in progress, will move towards fixed assets on completion. But at this point of time, the factory is kind of being built, so you keep it under capital work in progress. Similarly, if there is an intangible asset that is under development, let's say a software is under development at this point of time, this will be put under intangible assets under development. As soon as you develop it, you finish developing it, it will move towards intangible assets, long-term intangible assets, right? So that's the first bit that comes in, which is how do you deal with capital work in progress or intangible assets under development. Practically, they have to be included as a part of your total long-term assets that come up, right? So essentially, that's the premise that comes up here. The next bit is long-term loans and advances. For example, security deposits that you have given for renting out a premise. So if Aisha has taken a premise on rent, that's where the security deposits would come in. Or loans given to employees. If you've given any kind of loans to employees, that would also kind of come in, right? They will repay it, and that's a sort of an asset for you. Other non-current asset could include things like fixed deposits for more than a year. So if the company has gone and done an investment, which could be a fixed deposit kind of an investment, and then that's for more than a year. Other current assets could be assets such as accrued interest on deposits. Deposit something in the bank, there's an accrued interest, you have not yet materialized or taken it out. Loans given which may come within a year. Unbilled revenue would also be under other current assets, essentially, right? Let's look at the balance sheet and let's go to the notes. So let's talk about note 12 onwards, where we get this. So note 12 talks about non-current investments. They would have investments in certain companies that would come here. Then you have long-term loans and advances, which talk about if you have given any kind of capital advances, security deposits, loans and advances to employees, etc. Balance with the government authorities that you've already paid, that's there. Any kind of tax that you had paid in earlier years, but you're going to get a minimum alternate tax credit entitlement. Any kind of advance income tax that you have paid, right? So that additional tax that is paid is long-term loans and advances. You'll probably receive them at some point of time. Other non-current assets are kind of fixed deposits. Then you have current investments, which is all the money that is basically cash equivalent is lying in some debt mutual funds kind of data. And that's effectively cash and cash equivalents. So all current investments have to be treated same to the cash and cash equivalents. You follow subsequent data points, which is inventories, lower of cost and net realizable value. What's the inventory that they hold? Trade receivables. What are the trade receivables that they have? Outstanding for a period exceeding 6 months. Secured considered good. Unsecured considered good, unsecured considered doubtful, and all those are kind of given there in details. And then you have cash and cash equivalents, short-term loans and advances, any security deposits that you have given, any loans to related parties that you have given, similar group companies, loans given to those, any advances given to suppliers, etc. will come under other loans and advances, right? And then you have unbilled revenue, interest accrued on current assets, on fixed deposits, etc. All that would be a part of other current assets. So primarily speaking, that's the broad sense of all the other headers that are there on any given financial statement under the annual report. That's the important part that we would like to kind of discuss. We will build upon this with subsequent other companies and discussions around those companies. But a basic level understanding of all the headers is what we wanted to kind of cover up at this point of time. That's it in this particular section.